Hi, gang. So, part two of our investments stock intro here. So, with stock, we have two main ways that we get a payoff. One is from getting cash payments from the company. Those cash payments are called dividends. We'll see more on those coming up. And the other way is what people typically think about when they buy stock. Oh, let's buy this company and the stock price will go up and we'll make lots of money. And that increase in the stock price is called a capital gain. The downside, where the price goes down, is a capital loss. We don't like those as much. But anyway, so that's, again, how we typically think of making the big payoff from stock is with the price going up. So you want to buy Apple Computer stock and have the price double or triple after you buy it. So the market value of a stock is, hey, what's its stock price? And that changes as the day progresses. So anytime the market's open, that stock price is going to be changing. So let me see if I can get one here. Shoot, I was going to try to get a... So here, let me drag over. The market's open right now. There's the quote for Apple Computer, 263.30, 263.20. So this changes throughout the day as investors are buying or selling. This is the last trade that was executed. This may be 15-minute delayed, but this is set constantly based on new information and supply and demand. Anything going on, price changes. Right now for the day, you can see Apple Computer's up a little over 1.4% versus where it closed the day yesterday. So, of course, stock prices generally don't stay the same at all. All right, the current price that you see, so we just saw Apple Computer's price changing and all. That price is based on not the past. It's not based on, hey, what did Apple Computer do for me yesterday? It's what do I think Apple Computer will do for me if I buy it now? So it's based on expectations about the future. So if there's suddenly news that Apple's going to produce iPhones, they've got a way to keep their workers secure and be able to produce iPhones quicker and not worry about pandemics, then that could lead to a price jump, even though whatever that is may not have happened yet. So the prices are based on expectations about the future, and then anything that happens going forward that differs from what we expected to happen is going to cause the stock price to move. So prices are based on expectations about the future. If there's suddenly word came out today that a vaccine is expected to be on the market in a few weeks, and I haven't heard anything like that, and that's not the news that I've had. But anyway, if something did come out like that, then the stock market would jump up, not because the virus is there now, but because there is a strong expectation that it will be there shortly. And then if that vaccine did not come to pass, then price would drop, because it wasn't there. So prices adjust based on what we expect to happen. The total return for a stock includes both those capital gains that we just mentioned. That's the price going up, so the change in market value. So you get part of your return from owning a stock from capital gains, price going up, and you get part of your return from owning a stock from the dividends or cash payments that you collect from owning a stock. So this is just a way of calculating that as a percentage. What dividends do you collect over the year, for example? What was the change in the stock price over the year? Divide that by the price at the beginning of the year, and that gives you your percentage change there, percentage change in your total value. That's your total return. So part of your gain from owning a stock comes from dividends. Part comes from that price of the stock hopefully going up instead of down. course, if the price went down, that would offset any dividend yield you might have. So dividend yield is just your percentage return from the cash dividends alone. And dividend yield, you see that right here. This is part of a basic quote. You'll see that this company is paying, a Southern company, paying a $2.10 per share dividend, and that's 4.8% of the current price, roughly there. Here's dividend or stock trivia for 100. How often do companies typically pay dividends? Well, we know companies typically pay interest or coupon payments on their bonds twice a year. They generally pay dividends 4 times a year, and that lines up with earnings announcements. There are quarterly earnings announcements, and stocks typically pay dividends 4 times a year. So if the annual dividend is $2.10 here, we would be paying roughly a fourth of that each quarter. Well, I say roughly a fourth of that because the company may be increasing their dividend over time, and so that could change going forward. We also could have a decrease in dividends, but those are less common. So yeah, the dividend yield is just your annual dividends per share divided by your current market price. So we saw that. Let me back up here. So dividend yield, we've got the dividend here divided by beginning price here. And so at the time we're buying, that's our dividend yield. And that's just it right over here, your annual dividends divided by your current price. So, let me double check this. $2.10, 2.1 divided by 43.73, the current price, and I get 0.04802. So that's the 210 divided by 43.73, which I knew that's what it's supposed to be. Just that was the auditor and me doing that. Now, dividends, most investors, they get excited about the stock price going up, but dividends are also a key part of returns for most stocks. Not all companies pay dividends, but anyway, over the last 140 years, the dividends have become less important because in large part because for tax reasons, companies have paid less dividends. But over the last 140 years, dividends were a big chunk of the total return. So 5.9% on average of your return came from the stock price going up, and 4.6 of the total 11.5 came from dividends. And then over the last 80 years, dividends importance went down. Over the last 40, dividends even less significant. So companies are paying less in dividends, and they're doing things like share repurchases instead. We're just buying back the company stock, and that helps the stock price go up. When a company buys back their stock, if you hold on to your stock, you see an increase in your stock price generally because there are less shares outstanding. And tax-wise, if you buy, this is a nice thing, tax-wise, if a company pays you a dividend this year, you owe taxes on that. If the price of your stock goes up, so suppose you'd bought Apple Computer stock for $200 a share and it went up to $263, how much tax do you owe on that? Trick question. You don't owe any taxes until you sell. So even though the price of Apple Computer stock may have gone up 30% since when you bought it, as long as you hold onto it and don't sell it, there's no tax on the capital gains. Now, any dividends you collected, however, you do owe taxes on those each year. So that gives an incentive to, in general, for, hey, everything else equal, when would you rather pay your taxes, now or later? Well, of course, later. So if you don't need the cash flow from your stock, you'd much rather not have the dividends and then pay your taxes much later when you start selling stock. But then when people get big capital gains, the decision to sell is delayed or whatever, can be impacted significantly by the taxes you'll have to pay. Because imagine you'd bought Apple Computer stock years ago for $20 a share. When you sell, you're going to owe capital gains taxes on a big chunk of that. All right. Now, I mentioned this before. Bonds typically pay higher income amounts than stock, but stock dividends can and do go up over time. So that's an advantage to stocks. Bonds typically have the higher percentage payout up front, but the payout on stocks, the dividends on those can and will go up over time. And stock has a lot more capital gains potential, price going up potential versus bonds. Now, here we go. Stock's dividend payout ratio is just what percentage of its earnings does it pay out as dividends. So imagine a company makes $3 a share. If it pays $2 per share in dividends, it is paying out 2/3 of its earnings as dividends. So that's the dividend payout ratio. So what percentage of the company's earnings does it pay out as dividends? Now, earnings per share, remember way back when we saw the income statement for an individual. Companies have their own income statements and they follow slightly different rules, but earnings per share for a company would be basically their net income divided by however many shares of stock there are outstanding. Remember I said you're a part owner of the company if you buy stock? Well, your share of the income would be, well, per share. Your per share of the income would be what's the total earnings of the company divided by however many shares there are out there being traded, and that gives you an earnings per share amount. You multiply that times your number of shares, and that's your piece of the earnings pie. Oh, okay, so back up here. So dividend payout ratio, what percentage of our earnings are we paying out as dividends? Are we paying out a lot of our earnings as dividends? Are we keeping those earnings and putting them back in the firm? So for the firm, which is better, paying out very little of their earnings as dividends or paying out a lot of their earnings as dividends? And this is one of those trick questions. It depends. If the firm has a whole lot of growth opportunities, so if let's imagine a restaurant chain's kind of a depressing time to be a restaurant chain, but let's say we're a business and we're just starting up our new mask, new designer masks. That's a swell thought. Actually, I see those in the future. So new designer masks. Anyway, so we're still trying to produce more machines, come up with new mask designs, etc. We've got a lot of growth opportunities. So instead of paying out dividends, we would pay that company, our mask company, Bandits are us, we're putting, not to imply that you're a bandit for wearing a mask, but anyway, you're putting your money back into the firm, and you need all the money you can get to grow, so that company would pay out little or no dividends. Now, if we're an utility company, so a power company, let's say we don't have a lot of growth opportunities. All we're doing is serving the local community, and we're happy with where we are now. We don't need money to plow back into the firm, so we're likely to pay out a large percentage of our earnings as dividends. So again, the answer here, what's better for the firm? It depends on where that firm is in its growth stage. So is it beginning out with a lot of growth opportunities, or is it a more mature company that's kind of gone everywhere it can? Now, from an investor, same little bars there from an investor point of view. So you or I, should we be buying a firm that keeps most of its money and doesn't pay very many dividends, or one that has a high dividend payout ratio? This is another one of those trick questions. It depends. What are your investment goals? If you're saving for retirement, you don't need cash flow from dividends. What you want is to grow your wealth over time. So you're more interested in a company that is growing its valuation. So your focus is on stock price going up. That's capital gains. You don't care about dividends. If, let's say 10 years from now, I'm retired and I want some cash flow from my portfolio, I would look maybe for some companies that paid regular dividends. So different investors can pick the companies they like based on, among one of the characteristics here would be on dividend payout ratio. Alternatively, I could sell stock as I needed it, so I could go, either way if I wanted cash flow. But these, are a secure, maybe a potentially more secure thing, and don't involve you having to sell stock when the market's down. So if I had some dividend paying stock, even if the market's down, I could hold on to that, and as long as the company's still able to pay its dividends, I'm still collecting that cash flow, and I can wait for the stock price to bounce back. And then bonds also would be paying that cash flow. All right. PE ratio is an important valuation measure that's widely looked at. We're not going to get deep into investments topics here, but I'm going to touch on this one because it's one of the most important relative valuation measures. And the PE ratio is just a company's or a stock's price per share divided by its earnings per share. We just talked about earnings per share, and the price per share is just the current market price. So let me grab Apple again. So the current market price right now for Apple, I don't remember what it was a minute ago, is about $263. And the PE ratio for Apple, that's just its price per share divided by its earnings per share. This is more of a charting site here, but their PE is actually $20.73, not dollars. It's 20.7 is the PE ratio, so about a PE ratio of 21. The dividend yield is about 1.2%. That's a side there. Earnings per share, $12.75. It should have a dollar there. Well, I guess they don't have dollars on any of these, but $12.75 per share is their earnings. The current PE ratio is about 21. So there are differences. You may look up PE ratio. Don't lose too much sleep over this, but I want you to know that you might go to different sites and see different PE ratios for the same company, and that's because there are differences in the way E, for the most part, is handled. The price in the PE ratio is usually the current price. So the price per share is just, hey, Apple's $263.10 right now. The earnings per share is most commonly the last 12 months. I think that's the most common way of doing it. That's known as a trailing PE. So we're looking at historical earnings. Now, some analysts say, what's more relevant is where earnings will be next year. That's the forward PE ratio. So that's using a forecast of next year's earnings. The problem, what's the problem with this forward PE? Well, of course, we don't know what next year's earnings really will be. We have forecasts of that, but the one thing that you can rest assured of with forecasts is that they're generally wrong. It's just by how much are they wrong. All right, so where can you find a company's PE ratio? Well, I just showed you one here on tradingview.com. It's more of a charting site. There's the PE ratio. But basic quotes typically, or more expanded quotes will typically show this. So here's our PE ratio for Southern Company at the time I did this, and it's got PE, TTM, and then 2021. 20.2 is the PE ratio. The TTM, what's that stand for? 12 trailing months. So this is a trailing PE. Same thing with earnings per share, 12 trailing months. So pretty much any of your nice detailed quotes will have this PE ratio. So that's why I'm showing you this to you. It's one of the most widely circulated relative valuation measures. So, and then we'll touch on what market cap is. EPS is earnings per share. Dividend, that's $2.10 per share. Dividend, the yield, that's your dividend divided by your current price. We already saw that. So we know PE, EPS, and these we're going to, volume is just number of shares traded. Average volume is the average volume, and this is over 3 months. Days range, the price during the day went from this to this. 52-week range, here's the how the price changed over the 52 weeks. I think we saw bid and ask before. That's the price that the stock closed at yesterday. There's the price that it opened at. So the difference, well, there wasn't much of a difference there, but it can be a significant difference in that. And this is, not all your quotes will have this, but this is analysts' 1-year target estimate. This is analysts think this is where the price will be in a year. Well, for Southern Company, they weren't expecting much of a change. Beta, we'll talk about that. And then there's when, it's just when do they think the next earnings announcement would be. All right, so PE ratios, let's talk about this just a bit because again, it's a widely quoted valuation measure. The average PE ratio of, say, the S&P 500 index or large company stocks or the overall stock market over the last 80 years or so has been about 15. So on average, investors are willing to pay $15 for every dollar of current earnings. Let me back up to that PE ratio. So the PE ratio is how much you're willing to pay now for every dollar of, this is the problem with the PE ratio, the trailing one that analysts don't like, how much you're willing to pay for that historical dollar of earnings. So on average, that ratio has been about 15. One way of thinking of this, or one way of looking at this historical PE ratio, is if the PE ratio is below 12, this is the average below 12, that's an undervalued market or underpriced market, maybe a signal to buy. If the PE ratio is above 18, that's historically been a signal that we're overpriced. And well, right now, I think the market is still, despite the drops, probably in the overpriced category. See, I should have looked that up. 100, let's see. See if this has got it right now. The current PE ratio, we had this big drop, is still, but earnings have dropped too, and their earnings are going to drop some more. So the PE ratio that I'm seeing right now from one site here that tracks this is still about 20. So well above the historical average. This, people will say, oh, things are different now, and in part they are. One thing that leads to higher stock valuations is we have very low interest rates, and low interest rates are good for companies. They can borrow at low amounts and invest that money and make more money with that. But anyway, so let's talk more about that PE ratio. So how much are you willing to pay for each dollar of earnings that a company has? Now let's say we've got a company that's expected to grow quickly. So let's say as soon as the pandemic ends, we think Amazon's sales are going to skyrocket and go up 25% a year for a long time. It's kind of hard. Amazon's getting bigger and bigger. But anyway, so, and that, let's say most companies are only expected to grow their earnings at 10% a year. So, or 5% a year. We've got a company that's got really good growth prospects. What would that generally mean as far as the PE ratio? Higher growth prospects for earnings and revenue generally mean higher PE ratios. So growth stocks that are expected to grow quickly, tend to have higher valuations, which means higher PE ratios. Now, one problem with growth stocks, suppose we've got a stock with a PE ratio of 100. That's I said the market average is 15. If you've got one priced at with a PE ratio of 100, that means, wow, this stock is priced really high. It's expensive. But let's say we've got a company that has been doubling its earnings for a while, got that high PE ratio. So PE ratio of 100, and analysts have been expecting earnings to double. But what happens if earnings increase just by 75% instead of 100? Well, remember I said that stocks are priced based on expectations. So if we've been expecting earnings to double, that's really, really good. But they end up going up just by 75%, but that's still really, really good. What's most likely going to happen to the stock price? Well, if you miss expectations, even if you do something really good, the price is going to go down because the price was based on those expectations. So that's just a potential issue with growth stocks. If they miss expectations, even if they're doing great, the price could drop. So you really can't have a stock where earnings that go up by 75% and the price goes down because we expected better. Now, value stocks or bargain stocks are stocks that have low PE ratios. So that's one way to find them. You look for stocks where they're relatively cheap based on that price per share compared to earnings per share, the PE ratio. So again, that's one way to look for stocks. You find a stock that's cheap and you hope that, hey, something good happens to it and the PE ratio gets higher there. If people are optimistic about the market as a whole, will PE ratios be higher or lower? So remember, I'm going to pop this up, coming up again soon, I think. But if you're bullish on the market, that means you're optimistic. You think prices are going to rise in general. If overall market is bullish, people tend to pay more for stock, and that drives the PE ratio up. And well, let's pause here and take a break on the investments topic of stocks, and be safe out there.